Hey guys, welcome to DevTech Finance. In this video, we would be covering the topic credit evaluation of term loan. This video is a part of credit management tutorial, so I recommend you to watch all other videos related to this. Let's start with the introduction to term loan. So term loans are the loans whose repayment period extends for a longer time. Since the duration of loan is longer, the risk involved is on higher side. So generally all those loans whose EMI payments would be made over a longer period of time, for example 3 to 10 years, those loans would be considered as term loan. And for lender, the risk is on higher side because the duration of repayment is longer. The chances of default is higher. So the risk involved is higher for the lender. Now, thus to reduce the risk of default, what lender needs to be done, what lenders need to be do is that they need to evaluate the credit proposal of the business. They need to evaluate the performance of the business and the repayment capacity of the borrower in proper manner. So credit appraisal of a term loan denotes evaluating the proposal of the loan to find out repayment capacity of the borrower. Normally, these loans are extended for 3 to 7 years, and these loans are taken for various purposes which involves huge capital. So it may be like acquisition of any fixed assets, setting up of any new factory, expansion of the business, purchase of any huge machinery. So all these kind of activities, they involve huge capital to be invested, and for these loans, to serve these purpose, the term loans are taken, which extend for a longer period of time. The repayment comes from revenue generated from the uses of asset or project for which loan was granted in due course of business. So for any particular acquisition of asset or for any particular project for which the loan was taken, the cash flows that would be generated by the use of that asset or through that project would determine the repayment capacity of that business. So that cash flow generation should also be analyzed. Now let's move to appraisal of term loans. So basically, what all are the factors which broadly needs to be considered before providing term loan to any business or individual? So the first is management assessment. In terms of business, when we are talking, we need to assess the management position of that particular company. So who all are the chief executives and directors of the business? So basically, the people are the one who are running the business. Their objectives, the goals of the business would be determined by them, and thus the chief executives and directors need to be assessed in order to know the management position of the company. Their experience in particular industry. So the industry in which their business is existing, what all experiences those management people are having in that particular industry, that counts a lot because their experience would help them in running the business smoothly over a period of time. Now their academic qualification should match with the that particular sector, with that particular work. So for example, if we are talking about any business which is involving engineering work, the management should be having the proper degree related to engineering, so that their qualification could justify their work, and they would have a good idea about how the work should be conducted. Their skills and knowledge set, their succession plan. So succession plan is determining who all would be taking their position after they leave the company or after they resign. So the succession plan would be giving an idea about the upcoming CEOs and management of that particular company. So this was the management assessment which need to be done to get an idea about who all are the people who are holding the business and how strong are their capacity of running the business. Then comes the technical feasibility. So the location of project, where the business has been set up, the manufacturing process and equipment, what would be their final product. So for example, the loan has been granted for launching any new product. So what is that product? What would be the demand for that product? The regulatory clearances. So is the business abiding with the laws and rules regulations which should be compiled by the business or not? So regulatory clearances, are they having from the government? Are they following all the rules and norms? So project implementation, whether the project is being implemented on the timely manner and what would be the cash flow generation, the projected cash flows, the revenues from that particular project. So all these would show the technical feasibility of that company. Now let's talk about the marketing assessment and financial assessment. So till now we saw about the management assessment and technical assessment. Now coming to marketing assessment. So for going with the prior example, when the loan is being taken for launching of any new product, so here we can consider that what would be the target market for that product, whether the demand and supply, what is the demand and supply for that particular product could be known through market surveys. So whether the demand is growing, whether the product would be having high demand or not, that all could be analyzed through survey. The consumer preference in terms of that product, the marketing mix like place, price, promotion and product, what would be that, the life cycle of product, when the product would be at growth stage, what would be the decline stage, when likely is the product to diminish from the market. All these things need to be assessed, because this would give an idea about the real scenario of market when where the particular business would be growing. Finally comes the financial assessment. So financial assessment becomes necessary to get an overall idea of the financial position of the business in terms of its profitability, in terms of its revenue, in terms of its capital structure, the cash flows, etc. So financial assessment need to be done, and some of the tools which could be used are like comparative and common side statement. So comparative and common side statement are basically analyzes the balance sheet and income statement, which gives an idea about asset and liabilities and profit and loss of the company over a period of time. So that helps in knowing that how the business is performing in last 5 years, last 10 years, last 3 years. So whether there is a stable growth or not, whether the company is fluctuating in its business scenario, how is the business performing, that could be analyzed through comparative and common side statement. Then the projected cash flows, which would give an idea about the cash inflows and cash outflows of the business. So for any particular project for which the loan has been taken, what would be the cash generation from that project? Would that be enough to make the repayment of that loan? That need to be assessed. Break-even analysis. So when the cost would be equal to revenue, what would be that particular time period? That is referred as break-even analysis. What would be that position when there would be no profit or no loss and the revenue would be equal to the cost which was incurred? Then various ratio analysis, which plays an important role. So some of the ratios which matters a lot when it comes to term loans are like debt coverage ratio, interest coverage ratio, and the debt equity ratio, which gives an idea about the capital structure of company. Interest coverage ratio gives an idea about whether the business would be able to make the interest payment timely or not. The collection period ratio and various other ratios which shows the liquidity position, the efficiency position of the company. Then the sensitivity analysis need to be done to know the deviation from the projected financial scenario. So what could be the deviation? So taking in consideration of a certain deviation, what would be the revenue or the projected financials of the company? Then the payback period, NPV, IRR, which gives an idea about the worthiness of a particular project. So in what time period the project would be able to make the repayment of the cost involved. Then the net present value shows the present value, and where NPV would be positive, that project should be considered as a good project and the loan could be provided. Similarly, internal rate of return gives an financial idea about what would be the project capacity in making the repayment. So all these tools could be used to analyze the financial position of the business. Coming to borrower evaluation. So if we need till now we were evaluating the whole of the business. So how the business is performing in terms of its marketing scenario and financial scenario and technical scenario and its management scenario. Now let's talk about few criteria which would determine the borrower evaluation. So first is repayment capacity. Second is documentation. All the documents which is presented should be as required by the loan. So what all documents is required for granting that loan, those documents should be presented to the lender. projected cash flow should be presented, because the loan is being provided for any certain project. So what would be the cash flows generation from that project? Will that project would be successful or not? Supervision and follow-up. So supervision and follow-up need to be done by the lender of the borrower at every stage, so that it gives an idea about what was the projected scenario and how the actual scenario is going. The loan collateral value. So providing any loan without security is risky, and since term loans involve a higher period of time, the collateral value which is taken should be determined. Auditor's report would give an idea about the financial position in the true manner of the company. Tax assessment report will show the taxability of the company and whether the company is paying the taxes regularly or not. So these together compiles the certain factors on which the borrowers could be evaluated. Now, after assessing the whole business, the borrower on these certain criteria, the credit evaluation of term loan is done, and this could be gone into details to study and know the performance of business, to reduce the risk of default, and to make sure that the repayment of capacity of borrower would be good enough to generate funds for the lender and for the successful operation of the business. So thank you for watching. This was all for this video. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you all.